Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
Are you looking for a smart way to reduce your tax bill before the year ends? The 2024 federal budget brought in some changes to tax policy that will have a major impact on a particular segment of the Canadian market. If you expect to have a high income this year, or if you sold assets for a substantial profit, there's only a short window of opportunity to get relief. I'm John DeGuy, portfolio manager with Stand-Up Advisors at Design Securities. I've spent my career working with people who have a number of financial challenges. And one of the biggest challenges is tax planning. Tax planning is important for all income levels, but it likely gets the most attention for people who are in the top bracket. Across Canada in 2024, that kicks in at around $240,000. Provincial taxes are added to federal taxes for a total tax burden, and in my home province of Ontario, the highest tax rate comes in at 53.53%. In other words, as your income approaches $250,000, more than half of every dollar you earn ends up going to the taxman. Many people will recall that the federal budget this year increased the inclusion rate on capital gains from 50% to 2/3, or 66.67%, provided that those gains were on more than $250,000. Gains up to and including $250,000 will still be taxed at 50%. For a couple of generations, one of the few tools available to retail investors in a high tax bracket has been the existence of flow-through shares. They're not for everybody. In fact, if you're not in the top tax bracket, odds are high that they might not be for you. In order to qualify as an accredited investor, you need to be earning at least $200,000 or have a combined income with a spouse of over $300,000 or have $1 million of net liquid assets. That's what's required if you want to buy flow-through shares directly as an accredited investor by way of a bought deal. Without a meaningful way to test for sophistication, the industry uses income and assets as a proxy for sophistication. Over 50 years ago, the federal government made changes to the Income Tax Act to assist the Canadian petroleum and mining industries in their quest to fund exploratory and developmental drilling. These companies were granted tax deductions as they developed strategic Canadian resources, and these same companies were allowed to flow through or pass along those deductions to people who buy a special version of the new shares. More recently, the deductions for the development of the oil patch have ended, while deductions for critical mining exploration have been increased through income tax credits. Flow-through shares often trade at a premium because they offer a tax deduction. All else being equal, investors would prefer flow-through shares over non-flow-through shares in order to claim that deduction. For instance, a company whose shares trade at $10 might sell its flow-through shares for $11.50 because the people who buy those shares know they can claim a tax deduction against all sources of income for the amount they purchase. So as a simple example, if your income is $500,000 and you buy 10,000 shares at $11.50, that's $115,000 that you can deduct from your income, so that you pay tax on only $385,000. Because the value of the shares is tax deductible, the adjusted cost base is deemed to be zero. In other words, if you were to sell those shares for $115,000, the proceeds of that sale will be taxed as a full capital gain. Over the years, a number of companies have offered limited partnerships so that ordinary investors can also get access to the diversified basket of flow-through shares, not just accredited investors. While they worked reasonably well for a long time, those shares had to be held for a certain period, often more than a calendar year, which put ordinary investors at risk of a significant drop if the commodity price or the company's share price dropped before the company partnership could be liquidated. More recently, companies have solved the timing problem and illiquidity by giving investors access to the bought deals that I talked about initially. That's where the investor gets the tax deductions immediately, and the shares are resold to an institutional buyer at the predetermined price on the same day. That removes the risk we talked about earlier. Given the higher inclusion rate on assets sold after June of 2024, the use of flow-through shares may be particularly advantageous this year. A number of people triggered sizable capital gains, even if they were triggered before the inclusion rate increased. The expectation, therefore, is that more people than usual should be considering the flow-through option in 2024. It should be noted that flow-through shares can also be used in conjunction with charitable gifting. There are a number of strategies that can be employed that allow investors to be both flexible and purposeful in their year-end tax planning. Unlike RRSPs, where you can contribute for up to 60 days after year-end, Flow-through shares need to be purchased during the calendar year so that the deduction can be claimed for that year. All told, there are a number of substantial benefits for those people in need of tax relief. If you're concerned about your tax liability this year, you should at least give serious consideration to the flow-through option.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdeguy@designedsecurities.ca.